Most people think Medicare is free, or at least has a fixed monthly cost, but that's not exactly true. In fact, depending on your income, your Medicare premiums could double or even triple without warning. It's called IRMAA, and it's one of the most overlooked, frustrating, and totally preventable retirement expenses. I'm Cary Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. And in today's video, we're going to walk through what IRMAA is, how it affects your Medicare costs, and what you can do to manage it intelligently. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge that gets added to your Medicare Part B and Part D premiums when your income exceeds certain thresholds. But here's the thing, it's not based on your current income. It's based on your modified adjusted gross income from 2 years ago. So if you're enrolling in Medicare this year, the government is looking at your tax return from 2 years prior to determine what you'll pay. That 2-year look back is critical. Many retirees unknowingly trigger IRMAA because of something they did years ago, like a large one-time IRA withdrawal, Roth conversion, or selling a highly appreciated asset. Without proper planning, a one-time income spike can lead to higher premiums for a full year. Now, the income thresholds for IRMAA change slightly each year, but here's the general idea. If you're single and your income 2 years ago was under $103,000, or married and under $206,000, you'll pay the standard Medicare premiums. But if your income was above those numbers, even by $1, you'll fall into a higher IRMAA tier. And this isn't a gradual scale. These are cliff brackets. Go even $1 over and you're paying the full surcharge for that tier. That extra premium could cost you hundreds of dollars more per month. And over the course of your retirement, that adds up to tens of thousands of dollars. There are currently 5 IRMAA tiers above the standard rate, and they apply separately to Part B and Part D. So if you're over the threshold, you're likely getting hit twice, once on your medical coverage and again on your prescription coverage. So what counts as income for IRMAA? The income the government uses is called your Modified Adjusted Gross Income, or MAGI. It starts with your adjusted gross income from your tax return and then adds back certain items. MAGI includes things like IRA and 401k withdrawals, capital gains, dividends and interest, required minimum distributions, Roth conversions, and any earned income like part-time work or consulting. It also includes income from annuities, if not held in a Roth, alimony received for divorces finalized before 2019, and rental property income. Even some tax-free municipal bond interest may get added back in. What it doesn't include are things like qualified HSA distributions or life insurance proceeds, but you need to know what does count for your income because your tax planning decisions today could affect your Medicare premiums 2 years from now. Let's say you and your spouse had income of $210,000 2 years ago. That puts you just $4,000 over the IRMAA threshold for married couples. As a result, this year, you're now in IRMAA Tier 1. Your Medicare Part B premiums go from about $174 per month per person to around $244 per person. That's only an extra $70 each every month, but that comes out to $1,680 a year for the two of you, all because of a $4,000 increase in income from 2 years ago. Now imagine that number is even higher, maybe because you did a Roth conversion or sold an investment property. You could end up paying thousands more in Medicare premiums every single year. Here's a more extreme case. Let's say your income 2 years ago was $350,000. That puts you in IRMAA Tier 3. In that case, your monthly Medicare Part B premium could jump to about $428 per person instead of $174. That's a $254 monthly increase per person. Over the course of a year, that's more than $6,000 in added premiums for a married couple. And that's before accounting for Part D surcharges. It's not hard to see how quickly IRMAA can add up and how easily it can surprise you. So here's the big question. What can you do about it? The key is to plan ahead. And there are several smart strategies to reduce your IRMAA exposure, or at least manage it intentionally. For example, you could consider doing Roth conversions during your low income years, like between the time you retire and when you start Social Security or RMDs. Converting pre-tax dollars to Roth during this window can help reduce future taxable income and potentially can keep you below IRMAA thresholds later on. Now, on top of that, you can also use a mix of different account types, like Roth, traditional, and taxable accounts, to control how much taxable income you generate in any given year. That kind of flexibility is incredibly helpful when managing IRMAA risk. Or maybe you look at capital gains and plan them strategically. Realizing capital gains when your income is low may allow you to stay under the thresholds or even take advantage of 0% capital gains rates. Delaying Social Security could also help. If you're not yet drawing benefits, that's less taxable income, which means more room to maneuver. And also, once you're over age 70 and a half, you can use qualified charitable distributions, which is where you send money directly from your IRA to a charity that counts toward your RMDs, but doesn't count toward your income for IRMAA purposes. Another helpful tactic is tax loss harvesting in taxable accounts. Realizing investment losses can offset gains and reduce your overall MAGI, giving you more breathing room under the IRMAA brackets. So the bottom line, you can avoid IRMAA by being thoughtful about how and when you take your income and structuring things intelligently. Now, all of that being said, not all IRMAA is bad. Sometimes it's worth triggering it on purpose. So let's say you want to do a large Roth conversion this year to reduce the future RMD burden, especially if you're the higher earning spouse and concerned about your partner paying higher taxes after you're gone. In that case, paying IRMAA for 1 or 2 years may be worth it if it saves you tens of thousands in the future in taxes. The key is to run the math and decide on purpose, not by accident. It's also worth considering if you have concentrated capital gains from selling a business or a property. Accepting a year or two of IRMAA charges may be a small price to pay in the context of a much larger financial move that strengthens your long-term outlook. And then there's one more thing to consider. If your income dropped due to a life-changing event like retirement, divorce, or the death of a spouse, you can appeal your IRMAA surcharge. Social Security has a specific form for this. It's Form SSA-44. And if approved, they'll use your more recent income instead of the 2-year-old number, which could lower your premiums. Many retirees miss this opportunity, especially after they stop working, so it's important to stay on top of it and act quickly if your situation qualifies. So IRMAA is one of those hidden costs in retirement that most people don't see coming. But with smart tax planning and a little foresight, you can often reduce it or avoid it completely. It's not about fear. It's about preparation. Knowing the rules means you can make confident, strategic choices and keep more of your hard-earned retirement income for yourself. So if you want help building a retirement income strategy that keeps IRMAA in check, or just want to understand how your income decisions today will affect your Medicare costs in the future, you can always visit us at greenerafinancial.com, or feel free to reach out to me directly anytime. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.